Okay, okay. Please confirm you can hear me, please. A very good afternoon, ladies and gentlemen. Please confirm you can hear me.
Yes, we can hear you.
Okay, so at this juncture, ladies and gentlemen, we are about to kickstart our Teach and Learn Series Masterclass 1.0. Welcome. This event is organized by Spe Abuja section. And of course, today we are pleased to have a petroleum economist advisor, Desmond N. Agboifo, who will be taking us for 2 hours on this amazing lecture. The slide you see right now is the order of events for today. Of course, we are starting with a safety brief, and after that, we introduce our speakers and our VIPs on call, and then we have a warm welcome remark, and then we have the moderator highlight the bio of the speaker, and then from 12:15 to 2 o'clock, about 2 hours, we have the technical lecture by Desmond N. Abonifo, and then from 2 o'clock to 2:10, we have question and answers, 10 minutes of question and answers, and then a closing remark by our program's chair, and then networking. So for a safety brief, we kindly appeal that please, for the course of this event, if you're not speaking, you leave your microphone on mute. You want to ask a question or give a contribution, raise your hand. The lecturer is watching the screen, and he'll give you the permission to ask a question or speak. For questions or comments, use C before your comments, and for questions, use Q before your questions. Of course, if you using your phone, if you check your menu on your screen down, you'll see the feature for chat where you can always send chats. We also advise that you ensure you can hear the fire alarm if you're using a headset, and of course be alert of your environment. If you're driving, please use the Bluetooth device on your phone. And then if you are at home, we also appeal that by no means you carry your phone to the kitchen or where you have a gas so as not to have an explosion. We believe that today's lecture will be stimulating, brain stimulating, and of course, very engaging. Ladies and gentlemen, of course, we are so pleased to have amazing personalities that have joined us on this call today. We'd like to start by saying a warm welcome to the program's chairman of Spe Abuja section, Professor Kafayat Adeyemi on call. Welcome, ma'am.
Thank you. Good afternoon.
Thank you. The program's chair is standing in the capacity of the section chair, Dr. Ikechiko Okafor, and of course, she is representing him for today's event. We also have on the call our amazing membership chair, Dr. Ogene Rume Ogulo. Dr. Rume, welcome. Celebrate you. Thank you for joining us today, sir. Okay, probably he's not near his phone. We also have the speaker for today on call, ladies and gentlemen. Please help me welcome Desmond Agboifo. Confirm you can hear me, sir. Welcome, sir.
Good afternoon. Thank you very much. I can hear you loud and clear. Thank you.
Awesome. Good afternoon to you, sir. We also have our assistant programs chair on the call, Dr. Malami Mohammed. Welcome to you, Dr. Malami. Pleasure to have you here, sir.
Good afternoon. I'm glad to be here. Thank you so much.
Thank you so much, sir. We also have our young professionals chairperson on the call. A warm welcome to Chizom Okoye. Welcome, Chizom. Okay, maybe he's not hearing me. We also have the assistant sustainability and community chair, Falalu Saidu, on the call. Falalu, welcome, sir. Pleasure to have you.
Thank you very much. Welcome. Good afternoon to all.
Yes, and also on the call, we have our assistant speakers chair, Ebel Onu. Welcome, Ebel, on the call. We welcome all of our senior members, all of our student members, all of our professional members. We welcome members from all other sections of Nigeria, Port Harcourt, Warri, Lagos, Benin. Thank you for joining today's event. Welcome. My name is Ofofano Akpan, and my pleasure it is to serve as your moderator for today's event. We switch gears immediately to listening to our leader, the man who is steering the section well. Please help me welcome for his welcome address, the section chairman of Spe Abuja section, Dr. Ikechukwu Okafor, ably represented by our program's chair, Professor Kafayat Adeyemi. Ma'am, the stage is yours for your welcome address, ma'am.
Okay. Good afternoon, everyone, and welcome to our first edition of our new program, the Teach and Learn class. It's the master series, and the aim of the masterclass series is basically to share in-depth knowledge on a particular topic or particular area in the oil and gas sector. And this morning, we have our speaker, who I know is ready to give us all he knows and much more on the topic, on today's topic. So I want everyone to listen attentively. He's a teach and then masterclass. I'm a teacher, so I expect you to have your pen, your notebook, your biro, and be ready to ask questions. And at the end of the day, I hope we all have an engaging, knowledgeable, and fruitful session. So thank you all for joining the masterclass. Thank you.
Thank you, Programs Chair, our ever active Programs Chair. Thank you so much for being the brain behind this new event by Spe Abuja section. Ladies and gentlemen, it's time to learn from Oga Desmond. Of course, the synopsis of the event is on your screen. Of course, as the oil and gas industry experiences growing interest in assets acquisition globally, successful farm-in operations have become crucial for companies to thrive. Farm-in operations offer numerous benefits, including risk management, access to new opportunities, technical expertise, capital optimization, industry collaboration. By embracing successful farming operations, the oil and gas industry practitioners can benefit from increased exploration and production, improved project economics, enhanced industry competitiveness. This juncture, ladies and gentlemen, will be introducing the speaker who, for the next 2 hours, will take us on this exciting topic. Desmond is a seasoned professional with a strong background in petroleum engineering and economics. He offers expertise in project development, assets planning, and strategy advisory. His experience spans upstream, midstream, and downstream sectors with a focus on economic modeling, project finance, and corporate planning. As a leader in the energy advisory and consulting space, Desmond drives impactful projects and cultivates relationships with C-suite decision makers. Of course, he's a petroleum economist and engineer with 14 years of experience in diverse oil and gas project development, asset planning, and strategy advisory and consulting roles. He has proven expertise in projects, finance modeling in oil and gas projects, economic modeling and analysis, upstream petroleum project planning, fiscal, of course, valuation studies, midstream economics, greenfield and brownfield investment analysis, new energy technologies, and global energy policy research. His key strengths includes strategic planning and project execution, corporate planning advisory, capital and project finance expertise, economic evaluation, leadership, and team management. Of course, he has several achievements. He's a recipient of the annual Balmoral Award in Project Management following research on upstream fiscal regime violation of Nigeria's petroleum industry 2011. He was nominated as expert visiting research fellow on energy policy studies by Nigeria's National Ministry of Petroleum Resources in the year 2015. Of course, he successfully led energy advisory and consulting company providing value to the oil and gas industry. He has a master's in oil and gas project management, of course, a bachelor's degree in petroleum, oil, and gas engineering. For inquiries, of course, his email is on the screen. You can take a screenshot of your screen. Ladies and gentlemen, please help me welcome the petroleum economist and advisor who will be taking us for the next 2 hours, Desmond N. Agbonifo. Sir, the stage is yours as you lead us on economics of successful farm-in for oil and gas operations. Okay, Desmond, I'd like to hear you, sir.
Thank you very much. I hope you're going to hear me loud and clear.
Loud and clear.
All right. Thank you so much.
I'd like to see your video if possible, sir, so that we can.
Absolutely. Absolutely. I hope it's a bit clearer now.
Perfect. Okay.
Okay. So maybe because of the network, I may have to bring it down a bit. Maybe just take it off at some point. But it's clear, right? It's quite clear.
Yeah, it's very clear, sir. It's very clear.
Thank you. All right. All right. So if you can let me know if you can see my screen. I have a few slides to share. I hope it won't be too much. I'll be sharing right away. Right, I think so. It's up now, so you should be able to see the slide. Okay. All right. Is it very clear?
Very clear, sir. Very clear, sir.
All right. Thank you very much for the honor. I think before I kick off, I'd like to say thank you and a very warm thanks to the coordinators of this section. Happy to be here always, as usual. Today, I'll be speaking on the economics of farming operations in the oil and gas industry. And I have a theme. The theme is focused on trying to unlock sustainable growth through successful farming operations in the oil and gas industry. So I have an agenda, kind of just a high level, just about 5, 6 points. I'm sure I'll be able to dive into specifics in this section just under the 2 hours. I'll start with an overview of farming operations. We'll set the context very clear, look at some definitions around it. And then, as usual, just to give a bit of heads up, I'll provide some kind of simple calculations uh, and some definitions as we proceed with some questions that follows. Very free to have participants also respond. It's not a quiz with awards or results to share in terms of first position and all that. Just sake of trying to get the points clear, and I'll also provide the answers as we proceed. So there will be a case study which I will address in two key phases. I'll look at the single phase farm outs and the multi-case farm outs. Then I have some concluding thoughts, and then we'll keep the stage open for Q&A. Okay. So just an introduction. I'm sure most of us are familiar with the term farm out operations, but it's always very good to set it very clear. Farm out operations is an agreement. Yes, an agreement where one or two companies come in to sign a portion of an agreement to be able to carry out some work program. This oil and gas farm out. So of course, farm out takes precedence in two key partners. So there's a farmer and the family, and the farmer has the right of the lease, and the family comes into farming, as the case might be, and together they forming a farming agreement. And the origin of farming is not particularly too clear, but there was a professor, Professor Hemingway, who said, that this term goes back to the ancient Roman Empire, where there's a rights for states to transfer rights, collect taxes, private individuals, provide services, and all that. Okay. So just generally, farm out has got a couple of schemes and contexts. The first is risk mitigation. Companies would typically want to farm out because they want to, as much as possible, mitigate risk as in terms of financial exposure during very high risk projects. I'm sure we are aware that oil and gas projects are always in hundreds and thousands of dollars, if not in the billions these days. So there's always that appetite to manage risk. And of course, for capital efficiency, where you need to appropriate your resources to leverage partners' resources, skills, maximize investments, and minimize redundancies in operations. And then I will dwell specific more on the areas where farmings are very essential, but it's also very key for exploration access. It's also key, that's the first phase of every oil and gas operation. So that's the best time to look into a farming type work. You want to farm in when there's a plan for an exploration. So that's when you do a lot of studies and analysis to ensure that you can manage your risk from the farmer or the family. And the fourth is to build that level of competence in terms of expertise to bring in your collective strengths, collaborate towards driving the success of the projects. Okay. And then I have some thoughts about how does it work in practice. So I wouldn't go through this in very fine details, but the key point here that I mentioned earlier is it's about capital optimization. So farming operations enables companies to optimize their capital allocations, and they focus on their collective strengths to be able to deliver value across the whole project's value chain. Okay. And it also provides a basis for companies to be able to farm into new opportunities, grow their collective reserves, enhance their positions in the global marketplace, and of course, provide a basis to grow potential. Okay, this is just trying to set the scene as we progress. And so just so very quickly, the section 2, we looked at how do we even understand, what do we understand by farming agreements? Uh, well, there are three key areas that makes it interesting: risk, expertise, access to expertise, and for collaboration. Okay. Now I've put a nice farming picture there just to show that it's it's very similar to what we know as farms, but this is an oil and gas farming. So if you hear the word farming, it's not necessarily an effort that links to agriculture, but it's actually a name that just denotes, coming in to partake in an activity that happens in the field, uh, just within the oil and gas value chain. And so it's important because the goal of it is to drive decisions. Decisions are key. Uh, one of the best um, advice that I've heard in recent time in my career, it's oil and gas companies don't just produce oil. As strange as it might sound, the whole idea is that you must profit from the effort. So every time you see an activity, there's an intention to make a profit out of the effort. So when they spend billions and millions of dollars, it's not because they want to just drill oil, it's because they want to profit from the enterprise. And that's also key for the decision making. And it's good to also mention that that synergy between the technical domains, the reservoir engineers, petroleum engineers, the geologists, and so on and so forth, that synergy between themselves and the decision making is where economics has its own role to play. So it's very key to drive decisions in projects. So and that takes a lot of effort to make sure that the best efforts are put in place. So you look at an economic model, you look at the pricing structure, you look at the resources, look at the reserve volumes, and all of those details around the probabilities. Now, those efforts are focused on trying to do one thing to drive profit, just to maximize profit in the efforts. There's a popular term in the economic world that says that the whole goal of companies is to maximize the economic rent, which is really a difference of the cost to produce because the value that they get out of the asset. So that difference is really trying to drive profit forward. So I have a simple, as we go into the more detailed specifics now, there's this is simple type typical timelines farming agreement. So there's an initial phase where partners according partners here for potential partners to collaborate. And then the key thing is in section 2 is that you have to run some economics. The economics is what really sets the agenda for the stages that follows that forward. And then if it looks good, which is what we will see as we proceed, then you come to the table to negotiate the terms. And the terms is where you hear some terms like working interests, you hear something like participatory interests, you hear something like carried interests, and so on and so forth. Now, when that is all firmed up, then you have to sign the contracts and then you implement the work program that has been defined in FDP stage, the field development plan stage. And then you begin to monitor the asset and what's often called operations management. Okay, so this is really what happens end to end in a typical farming type opportunity. The benefits, yes, it increases E&P activities. It sets an agenda to improve economics. This is a bit debatable because there's always a balance of risk and rewards. So typically your lower your risk should be your lower your rewards, but there's always that perception of risk. So what do you call a risk, or what do you call a profit or a value? There are different ways that this is value in economics. We should also look at those details clearly here. And then it enhances the industry's competitiveness because farmings will typically help to drive the industry's position at scale. And I also show examples of very model type, what we know as farming in the industry today. I have a slide that speaks to that also. So it shows, how key players can come together and, farm into operations and grow their own expertise as they proceed. So now it also provides a basis to leverage expertise. Again, you can drive synergies in financial planning, and you can facilitate larger scale projects, within a collaborative structure, and also provide access to improved and new markets that you can access as you proceed. Okay. And so I've got some, I call them the 4 Ws. There's a what, why, when, and whom. So this is clear for people to understand, well, what is this farming? I mean, when does it happen? How does it happen? So I have some very basic contextual definitions for farming. But the purpose is to be able to share risk and reward in exploring and developing an oil and gas asset or a property. Key elements of a farming includes equity participation, E&P obligations, cost, profit sharing and reimbursement, of course. And then you have a production sharing type allocation. And of course, you always want to leave the last point is always very essential, often less discussed. It's a basis to address disputes and issues around termination of clauses. But I leave that to the lawyers today. We're talking about the economics for today. Okay. So another perspective is that it's between a farming and a farmer. So a farming, it's the acquiring investor. I know the terminologies might come a bit, quite not clear, but it's good to understand that a farming is an acquiring investor, okay? And the farmer is the receiver from the farmer's investment. So together they are called the partners in a project, and the farmer could be called the primary partner. Most projects will have multiple type structures, but it's good to look at it just within the context of two key parties, and then you have different parties coming as carrying interest. I'll explain that as we proceed. Sometimes they're often called the carrying partner. Yeah, so you can have a couple of carrying partners that has got different interests in projects. Okay. Now, why? So why do people even go into farming operations at all? Again, you want to explore new frontiers, you want to share risk, yes, and you want to increase your capital efficiency. That's key because as much as the funding and projects comes in a lot of costs, you want to maximize the return on each capital. So you would typically see projects that have to do what is called a capital allocation process. And then they now ensure that projects that will tick the boxes must provide the best value at a point in time. So most projects will not necessarily tick the boxes correctly. And then well, if you have a limited cash plan for a project, then you'll be able to now, keep the options open for a farming. So it's essential to improve your capital efficiencies to be able to optimize your capital allocation and improve efficiency of your investments. And when does it happen? Typically, just in one word, it happens every phase, or it can happen in most phases of an oil and gas typical value chain, from the exploration to development, and even to M&As. It happens very, very clearly. I think in the next few slides, I'll show the examples as they follow. In E&P phase, of course, that's the period where you have the riskiest part of the project's perception and efforts. So you can farm it at that point in time. So parties can come together and bring in their value to, potentially get access to a portion of the pie in an exploratory asset. In development phase, yes, things are a bit clearer now. You can farm in to be able to drive the project forward. And then at the later time of the transactions or the project, you have the M&A, if possible. And that's also a precursor for M&As, merger and acquisitions, allowing companies to test the waters, assess their value in the partnership, and of course, derive return on their investments. And who does it happen with? So oil companies, oil and gas companies are the primary promoters of farmings, and E&P companies course, they are also part of this whole divide of farmings. And then very, very frequently you see investors or financiers coming to farming in projects. So I put them in three different buckets so that we can clearly see the dividing lines between them. Investors will typically farming because they're looking at returns on the investments. A&P companies are farming in because of the interest on an asset and also have some level of market share, as it were. Oil and gas companies will come in because they are looking to own a piece of the value at the end of the day. Regardless of whatever parts that plays in the farming operations, there's a clear definition of what is a return to them and what value they want to get out of the farming operations. Importance of risk sharing, clearly access to markets, operational synergies, improve financing, managing risk and all that. Okay. And then here are some very classic examples of farming within Nigeria and in the world also. We've seen the NNPC with SA Petrol, we've seen the NNPC with Chevron, we've seen the NNPC with Total, and on a bigger global stage, we've seen the reliance of India with BP, we've seen ExxonMobil with Eni. We've seen the Novatec with Total. Now, if you look at the dates within all of these farming operations, they date back towards almost 20 years or more now. That shows that it's not a very it's not a less known concept within the oil companies. And there's always a value. For example, Chevron and NNPC were looking at the Agbami field, over 1 billion barrels. Same also with SA Petrol being part of that. And if you look at the ExxonMobil and Agip, the 15 TCF of natural gas in the Mozambique corridors in the Rovuma Basin. These are clear examples that have provided value even for the multinationals and even the national companies. Okay. So I would speak to some very distinct terminologies so that as we go deeper, it will be clearer when we see how this happens. So the first is the JOA, it's a joint operating agreement, which is clearly a contract between two companies, set the conditions of the operations clearly in an asset. Now, there's a participatory interest whereby a company has ownership in an asset to a certain percentage of its participation in a joint operation. There's a working interest. The working interest is what portion do you own in the pie? So clearly, it provides a basis to have a voice on the table, and it's often after deducting royalties and other burdens, and you have clearly a working interest. This is very essential in economies I would look at as we proceed. And then you have the net revenue interest, which is the percentage of revenues from an asset that is received from each company participating in the joint operation. So you've got the gross revenues and you have the net revenues, which is after all deduction. And then that is often, so the difference between your gross revenues and your net revenues is often defined by your working interests. So if you have a 10% working interest, you have clearly a 10% of the revenues after you have deducted all expenses and royalties and so on and so forth. Okay. And moving on, there's a farming agreement that it's really a legal contract document that is signed between the two parties after all of the analysis has been done. I will show you a work plan and how that is also done. The farmer is the company owns the assets on the kickoff of the discussions, and it farms out to a family. Now there's an earning in the process where families earn their interests by meeting certain obligations, such as drilling new wells, sort of spending amount of the money, things like that. Now there's a carried interest. Carried interest is a provision within the agreement that the farmer agrees to pay a portion of the family's costs. Now, there's a typical term of the carry. The carry comes with two key terms. You have the carry cost, and then you have the repaid cost. So whatever you have been carried through, you must have a provision when that is repaid before you now begin to share profits. You have backing provisions where you now look at how does the family has options to reacquire again if you want in the future. after he has earned his own interest. Okay. Now, again, the phases are clearly defined. I won't go into this in much depth. But there are different phases where you have typical farmings. The key part of it is within the PSC structure, the production sharing contract structure. You have where companies can farm in within the phase of a typical sharing structure, and then it's typical to other regimes and the risk service regime also. It's also often very, very popular to see farmings in PSCs, farmings in risk service contracts, and even in A and P stages. Okay. So, section 3, this section will provide some contextual definition and simple calculations as we proceed. And please feel free to respond, maybe in the chat box. I'll be asking some questions, and I'll also give the answers as we proceed, just to gauge our understanding on how to proceed. Okay, so the first is earning calculations. An earning calculation determines the farmer's backing interest. It's always a percentage of the farmer's earned interest. So there's an example. Really, what is I think I've given the answers already away. But for example, you have a completed work program of $10 million, and you're looking at the work program itself of about $20 million. Now, assuming that that's the cost to drill 2 wells. So the question is, what is the earnings here? The work itself is it's coming in at 10, and total program itself, the whole work program that needs the funding is 20, but you're coming in to put in 10 million. So what's your earning share? Very simply, if someone want to try, that's just about half of that. Okay, so that's clearly the answer. I'm sure if someone has, or do I give a chance for someone to try? Anyone want to try on the next one? Okay, well, I would okay, let's try this one. Assuming you're looking at an example of a farm's expenditure cost of 15 million, and the carried interest is 30% carry amount. So what's the actual carry amount? If the carry percentage is 30% and the cost itself is 15 million. So clearly, just multiply 30% by the 15 million and you get 4.5 million. Now, these are contextual understanding that ensures that there's clarity to, oh, thank you. Chisom Okoye just said 4.5. That's correct. Thank you. All right. So, well, these are definitions that have to be clear, because when we come to the main economic model section itself, these are questions that need to be answered very swiftly to ensure that you get the job done in a good time. Okay. Now, you're looking at, for example, backing calculations. So the farming interest is 50% from earning calculations. Your backing percentage is 20%. So can someone try what would be our backing interest here? 10 seconds. Anyone want to try? Okay, well, the answer is 10%. So your backing percentage is 20%, and your earned interest from the previous calculation is 50%. So if you just multiply that, you have about 10%. So this shows a basis to determine interests and obligations in farming and farmer agreements, right? So the third question, okay, I think they are further down. All right, so this is enough for now. We'll now look at some kind of model calculation that happens. I wouldn't go through this in details again. I'll probably have access to share the slides. But it's key to understand that there are various metrics that drives projects, the MPVs, that depend on the discount factor and your internal rate of returns, payout time, and then you have the sensitivity analysis. I will show examples on this as we proceed in the next section. Well, these are key metrics to guide decisions on what is profitable in a farming agreement or not. Okay. Now, I'd like to provide some recommended steps for farming operations. The first is to be able to gauge the value of the assets. Now, I've provided some very simple examples here. It's a bit, I think it's kind of, this is an input from a typical time analysis that I've done in the past, where you have working interests, carried interests, different partners, and then uplifts, more like interests in the project. Then you have different cases, P10, P50, P90, different probability values of reserve volumes. You have oil prices and gas prices. It's an integrated asset. You have inflation values that are set to rates and driven by a specific time. Very kind of detailed analysis. Then you've got different uh, values of provision for D&A cost, decommission and abandonment costs. If you're going to be the UOP approach, the unit of production or the end of life assets scenario, you can run in a model on the PPT or the PI regime. And then you have financing provisions, if it's debt equity of 75%, that's general ratio, options to pay as you go, trying to reflect what your operational requirement provides. There's also an option for that. It's just typical type provisions in the model, but this is 208 million barrel asset and 306 BCF of gas, small scale assets. And so very quickly, I will just go straight down to the economics result that has been run. This is a step 2. So the step 1 is to understand that there's a basis to understand what asset value you're trying to run on. It's 208 and 306 BCF of gas. And then you quickly run down to, I'm trying to just make the slides go a bit faster because we have a lot to cover. Now, this is a typical type model analysis that has been modeled from the model I've shown in examples. So this is a P10 model running on the UOP depreciation scenario. The fiscal terms here are using Nigeria's type PIA. And the results are shown on the screen. You can see that the NPV, it's just about it's about $271 million, NPV 10. And it shows very, very distinct type results in an economic study. What is key here is there is an option for the carry. Let me use my highlighter to share this. So there's a section that speaks to the carried interest and the carry paid. I've defined that earlier. This project made a provision for about $4 million carry costs. And then clearly it has also made a provision for the 4 million repaid. This is just on the year of operations 2027. So this is typically what needs to be done in stage 2 of an analysis in a farming type operation. Okay. Now, next step is to now look at stage 3 that speaks to, you would have made provisions for all of the fiscal provisions of capital allowances, engage your pioneer status, apply the executive orders, and looking at your debt and financing type instruments to be able to carry out the post and pre-tax and financing cash flows. And then the third stage is that you should be able to provide what I often call a project cash flow waterfall. Now, as the term denotes, the waterfall just gives a story of how the project will be progressive to what is left as net cash flows for the project itself. So you'd have deducted all of the royalties, operating costs, capital costs, abandonment costs. The tax here is hydrocarbon tax and the CETA tax. And then your carry costs, repaid is all provided for. And then you have about $558 or so million as net cash flow. That's stage 3. And it provides a basis to move forward in the project or not. If it's a negative cash flow, then you have to reconsider the decision to invest in this project because you don't invest without a good clarity on the return profile. So that is also key that has to be defined. And then I always adopt this approach. I want to make sure that I understand what makes it profitable. So this is a chart that defines the project's return, discounted return of NPV on a scenario-based discounted factor. So you recall I've set it to 10. So the 10 is our is our base case project return. So if you are able to provide, this is an approach in Excel that is wrong with some macros. Can get through the different results of different type profile on discounting the project. So you can see that a high discount factor. In fact, if you're looking at the 22% discount factor, you have a negative cash flow. So that's must be wary that this is really what makes it uneconomic, as it were. But NPV 10 is $200 million, 270. And then I also provide, as a next step, you must provide what's often called a tornado chart or a sensitivity analysis, just in the page. But this provides all the key variables that drive the project. We look at the worst case and the best cases. So clearly, if we vary the input 30% on the extreme and to the left, this is the kind of profile we see. Clearly, we can see that oil prices are most sensitive to project economics. So when the prices go as 30% less, then we should expect that we'll be on a negative NPV, obviously. Okay. So this is the result wrap up. Now, I'm putting these processes so that when we now begin to look at the farmings in the next few slides, it will be very clear why we have to go into the farming or not. Again, it's good to look at the project level economics, look at the equity level economics, and the debt holder economics. The last portion is not always very to drive the project forward and the debt sharing and so on and so forth. But the project level is key because you want to make sure that you're looking at a 50% return on investment, NPV of 271, and your payout is just from this year to about 3 years from now. Okay. Now, section 4 would now begin to look at some kind of case studies. But I'd like to pause just for a minute or two, just to keep the floor open and ask maybe 1 or 2 questions before I proceed. Because from this section to the end, it's a bit much more interesting. And now we look at the numbers in depth. I'll allow the moderator to just keep the floor open for 1 or 2 questions before I look at the 2 type case studies that we have on the farming. Okay. So any questions at all? Comments? Clarity? Moderator? Anyone has questions to ask? Or can we just continue then? Okay. So section 4
Sorry,
will
I
be
have a question
all right.
to ask.
Okay. All right. Okay.
Yes, the chart on NPV sensitivities, where you
All right.
said it goes to negative.
Right.
I really don't quite understand the analysis there.
All right.
And that's
Thank you.
22%, yes.
20% where that's the previous one, you mean?
Yes,
Yeah. Is it
on
here?
table, yes.
Great. Okay. So yeah. The project economics has been run. I think I'll go a slide back so you can see clearly how that has evolved. I think it's in
Okay.
front. Right. So clearly, this is what has been run as the economics of the project. You can see it's NPV 10, it's 271 million, correct?
Yes.
Good. Now, one of the ways to stress test your project is to vary the discount factor. And what does it do? It helps to adjust your net cash flows to present value terms. The way to do that is you're trying to assess the value of the return of that projected cash flow in today's term. And the way to do that is to apply a discounted factor of 10. So when you get NPV 10, it means I have run the model on a 10% discount factor using a year-end based model. Now, the various models, you can use a year-end or the mid-year. Now, I've used a year-end model using a 10% discount factor on the $558 million net cash flow across the project life. That's across the about 20 years or so of the project's life. Let me go back to the table itself so you can see clearly. Yeah, good. You can see this is NPV of 558 million or so, right? Now, using a 10% discount factor, you have an NPV of $271 million. Now, this number is based on a 10% discount factor. Now, I think the best approach is to also vary your discount factor and see the impact on the NPV. So that's how this was generated. So NPV 10 is $270 million or 271 as this. Now, if you increase the discount factor to 12%, now what is the discount factor? Now, typically, it's run by a blend of the cost of equity and the cost of debt. Now, that average is called the WACC, as the weighted average cost of capital. Now, that number is key, and a better way to explain it is that that's almost like a minimum target that the project will return. So you're trying to vary the project sensitivities on your targeted return percentage. So each time you increase the targets, you see that the returns are coming down. And that's why you can see that as our discount factor goes from 10 to 12 to 14 to 16, our NPV goes from 270 to 39, 188, and goes down. So if you go down to 22% as a discount factor on this project, you have a negative of $2.9 million. Okay?
Okay, understood.
Maybe.
Yes, yes.
Okay. Okay.
It's
Thank you. Any other
clear.
question? Any other comments, questions? I'm sure we'll have more questions as we proceed more, as we continue. Okay. So here from this session and to the end of this meeting today, I thought it wise to provide two case type scenario in a typical farming operation. So you can have a single case project and a multiple case prospect farm out. So what that means is, assuming you want to farm into an asset that has just a single asset, one OML somewhere, right? That's a single case. Now, assuming you want to farm into a couple of assets, it's called a multiple case asset. Now, okay, there's a question by Ogolo, says, I wanted to ask if the farming fiscals, I think I missed a question. Can you ask the question so we can all hear? Or I should just go down to the chat box, I think, to see his questions. Okay, I think I'm trying to get your questions 1 second. All right. Yeah, it was asking if the farming fiscals have an impact on the actual unit costs of oil production. Well, the answer is yes. Yes, because can you hear me loud and clear? Thank you, Cap. Well, the answer is yes. The yes, because typically, yeah. So typically, the farming structure works in a base of risk and reward analysis. So if you're farming up to, let's say, 30% backing into a project, you obviously will have an improved economies than the owner of the project who has a higher investment on the project, because you have a lesser investment, and that depends on what is often called the basis to assess your interests. So you can see typically you have a carried interest where you have just an amount of money that is kind of maybe 10% or so. And and depending on the asset size again, if it's a buoyant asset, what you get in is what you get out. 10% of your investment in the project could mean a lot, could mean even having over 30% more as your return. But again, those dynamics has to be defined as the project continues, because clearly there's always that balance of risk and reward. When I would explain further, to give you answers more clarity, I will show you the basis why that is true in our multiple case scenario, where you look at bias analysis and sales analysis, and then we'll see a break even to see where that comes from. Okay. So moving on. Okay, so now I'll kick off with the single prospect farm out operation. So very quickly, assuming the first stage of the analysis to estimate the reserves, assess probability analysis, do an EMV analysis, EMV of an asset, to risk the probabilities across different scenarios. And then, so I have a simple question here. So if a seller has an interest S in the block, what amount of X of this interest should I be willing to assign to a buyer in exchange for the buyer's paying the seller's share of the expenditure C needed to explore the block? Now, I've put some of the bold requirements very clearly. Now, to answer the question very, very simply, let's look at the single prospect farm out. So prospect value, let's use our $270 million as our NPV on what we have done in the past, in the last few slides. And assuming the well cost is $40 million, assuming, and you have a chance of success of 25%. So it means that the project will fail by 75% as a probability, but success is just 25%. And interest is 60% from the seller. Now, these are very key informations. So the answer to this question is, I worked out the example, and you're looking at about 16% return in this project. So how does that come about? You look at your working interest of 60%, multiply that by your NPV of 271 million, then you divide that by your 25% chance of success times the cost. You must remember that the question is, what are you coming in to invest and what is your return? So two things stand out here, your chance of success and your working interest. Very key. Comparing that with your investment cost of 40 million and the return of 271 million. So that's about 16% as the potential value for the coming in for farming operator. Now, if that's the case, you must also remember that this is just a repetition of the previous slide. Now, the seller will expect to be able to relinquish 16% or 16.2% of his 60%, and it's left with what? 44%. So that's 44%. It's really multiplying that by the cost that he needs to bring investment for of 40 million. That's about $17 million, 17.6. So the seller will expect at least $17 million based on this simple case scenario. Now, I would be able to give you further analysis on this kind of example by the use of what's often called a data chart analysis. And I will share that, I think, in the next few slides. Now, we must remember, just for clarity's sake in this session, that the chance of success and the chance of failure is 100%. If success is 25%, failure is 75%. They are complementary. So typically, if the chance of success is less than 100%, then chance of failure must be definitely greater than 0. Okay. So now let's go now deeper. Let's look at the seller's perspective. Now we have seen what the buyer looks to farming for his return. Now the seller would also do the same analysis, but the results are different. And to your question, Mr. Ogolo, your working interest, multiply that by your project costs, right? If you divide that by the NPV and your chance of success, that gives you 39%. So the seller's perspective is higher than the buyer. Now, why is that so? It's because the buyer is, if he wants a portion of the investment to come, but what I've been defined here, and this is really for the lawyers or the legal team to put crystal clear that the basis of the sharing of the cake must be defined clearly. Because without that, it's about 39% of the project that goes down to the seller alone. Okay, except there's an interest to split the costs 50-50, and then you can now see that even distribution clearly. Okay, now I have provided some analysis that gauges the value of working interest and your chance of success. Now you recall that there's a 39% that has been calculated for. So I'll just highlight that for sake of clarity. Okay, now I provided different results of chance of success versus different results for chance of farming working interest. And everything you see here are the results spectrum of the whole result of the analysis. So what you see on the green is that 39%, 15% chance of success, 40% planned working interest. So to the extent that you increase your working interest, if that happens, and this is key to see, as you proceed from 40 to say 50, you see that your 39% grows to 54.12%. Now that's because you typically want to make sure that you are seeing the different chance of success scenarios vis-a-vis asset working interest. Now, what you could change in this project is you could focus on the chance of success because the working interest, assuming is fixed, you can't change that. The question will be, assuming we have an increased chance of success, how does my return increase? So to that question, Claire, you can see that yes, as you move further down, you see that something is going on. You see that reduced number as you proceed. That's because your interest is fixed, but the structure should have increased. But this is the perspective of the seller, not the buyer. For the buyer to be the other way around. So the chart on the right shows that the farmer has a base case, assuming it's 40% that is planned for, which is what we saw as the well cost. And then his break-even interest is that 39%. It's kind of, there's a marginal return, just about 1%. Now, this is key because if I was a seller in this case, I'll be able to ensure that I have an increased chance of success before I even bring in a potentially talk about farming. Because the seller, two perspectives here, the seller is looking for a cheaper value to assess the project. The seller wants to maximize return on the investment. So there are two varying perspectives. But what is key is the chance of success. Now, if it's an exploration project where the risk is high, the seller will always have an unfair disadvantage. But if it's a developing asset where things are a bit clearer, seller will have an unfair advantage. Okay? So this must be very clear as we proceed. Okay? So moving on, I need to go back on this. Okay, so any question on this slide before I go further again? Questions? Okay, no questions. Okay, so we'll continue. So just some response to that. If you consider that there's an S as working interest and exponential C, then the buyer is buying S interest times expenditure C, and the buyer receives X times V. Now the X here means what is his own return as minimum break-even point of his return. Compare that with the value that the project brings times the chance of success. So the buyer and seller are always in that relationship where you're asking questions. What is the buyer's break-even and what is the seller's break-even? So I've worked out examples here. The buyer's break-even here is about 39%, which you saw in the previous slide, similar to the seller's position here. Now the buyer's position is even to the seller's position. It's simple because, I mean, you have very, 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 very minimal returns on 39%, and even if the cost is about 40% of the total return on the project. So it's almost even at that point. So now, that's the question. So what then will be a deal breaker? So would you advise the buyer to continue or the seller to deal? Well, yes, the answer lies within their level of participation. So the opinion really lies in the value of the project. So you must recall that the project is $271 million, and the probability and chance of success are two critical drivers that should guide your opinion correctly. So it's often good to provide some analysis on the different chances of success and the different NPV profile. Again, here to the previous question by the professor, it's good to also understand that the NPVs are relatively driven by your discount factor. So all of this work has to be done. If it's NPV, look at different NPV possibilities, worst case, best case, high case, chance of success. worst case, best case, high case. Then you can now fairly make a deal. That's the idea. Now, the break-even is very much indicative of a generalized multiple source of profit and costs. So you must look at the portfolio type approach. Are there other opportunities that we can feast on within the farming? That is key, and we'll look at that in the next section. And this might be driven by an operator's perspective. And so we'll see that this in our simple example, if you have an interest, yes, in other assets in the same project, then you might just, stay put and look at the next bigger opportunity within the same asset. So the answer is not very clear here, but when we see a two-type multiple case, we will know exactly which should be a good deal breaker or a good deal maker. So here's an example. Here's a structured example that provides insight into the seller's break-even. So it's the working interest multiplied by the project costs, and you just divide that by the NPV and the chance of success. Now, there is a terminology, which is the SGN. It's a factor. The factor is often driven by the probability of your perception. That's why it's a perspective. Now, again, just to be a bit more subjective, it's good to, of course, it runs from a number of 0 to 1, being 0.5 as the middle. But typically, the factor for any benefit it offers, you'll notice that the seller's factor is always positive because he wants a higher share end of the day. Now, the buyer's own is positive for any benefit it stands to receive. So if the buyer runs an economics, the buyer looks at the positive side on what he tends to receive. So the SGN, this term here, is often essential to provide some level of succor in terms of his level of comfort level to run his economics. Now, it doesn't impact the result at all, but it just gives a value. But if it's less than 1, you see that definitely everything that is on the question line, the working interest and project costs, will reduce to the extent that the factor also reduces. So the buyer gets a positive number because he's trying to, set value. The seller gets the same positive number, but negative for any benefit he stands to receive. That's different because that's also key. The SGN, let me just highlight it so we can, to be very clear. So I'm using the red color to be able to highlight this factor that provides that level of risk appetite on his, and this is driven by many factors. It could be very similar to if you understand the terrain, understand the project, and then that number can go as high as 0.7 or 0.8. But if it's a new terrain, that can be 0.2 or 0.3, as the case might be. Okay. Now, let us look at a two-well scenario. Now, there are two prospects, the same prospect of one. You have the prospect of 40 million now, this time around lower NPV. You have a lower project cost. You have the same chance of success, 15%, and interest has gone up to about 45%. Now, the seller's perspective of two scenarios, assuming there is a $40 million of prospect 2, because prospect 1 has shown that there's a minimum return that could be gotten out from this deal. Now, option 2 has a lesser NPV. Now, these are just very, very simple examples. You're looking at around 16% return for a break-even. Now, this is the break-even of his return. So the interest here is coming at 45%, chance of success is 15%, it stays around 16%. Okay. Now, the buyer here has a well-known experiences in assuming it's a high pressure, high temperature asset, and the seller needs for the work program. The seller is prepared to concede to at least 35 million, and this number is run. I've run an economics to give me that, so the minimum that is needed to make this project work. Now, the seller feels he is likely to concede in the operatorship if given to the buyer. I reckon that the value of this work, instead of 40 million, is around 25, because the seller may have inflated or perhaps provided an escalated cost of the present value of the cost of the project, so say 25 million. So he wants to know what that value is today. Now, both of these points need to be addressed with certainty before any deal can be signed. but each probability is 1.0 on their both risk factors. Again, that can also be assessed and you see different results. Now, since the seller investment here is low, so the present value of the cost of the work program is 25 million. I think I said that earlier just now. Because definitely it's 40 million that is planned, but he's looking at assuming he can be able to, come in as an operator and do that less than what has been planned for. Again, that also gives him a leverage to come in with a lesser cost as a farming cost and maximize value because he's coming as an operator. Now, here is an interesting result between the two transactions. The seller's break-even and the buyer's break-even. The seller's break-even comes about 16%, and the buyer's break-even is about 10%. I think here it's very clear to know that the buyer will definitely be in a good position to say yes because he has a lesser break-even number, means that he has more to play with before he gets a higher break-even compared to the seller. And the answer adjusts on top of that, and the details are below that. Clearly, you can see that 25 million that is planned for his perceived cost of the work vis-a-vis the 15 million, which is really a cost that the seller feels that he can be able to, reckon that this is worth to the buyer. So he makes a deal and say, look, we can be able to do this at 25 million. Now the buyer looks at the 15 million buffer. And that's because this is the 40 and 25 has been 40 less 25 is 15. Okay. Now these points show that the project looks good, at least to the buyer. Every time there's a lesser break-even number, assuming you have an economics project model that you have built, and project A is $5 per barrel, project B is $2 per barrel as both break-even numbers. Of course, obviously, project B is better because you have a lesser break-even number. It means that you are more buoyant to proceed. That even at $2, you've already gotten all your costs or all your investment costs back. So same also applies here. So typically, buyers will use a higher discount rate, which is true. The reason is simple because a higher discount rate will definitely provide a reduced return. But it's a way to stress test what is coming in as a value in the project. Now, the buyers first sees the first approach as less attractive than the seller. We must understand that the project farming is a subject of a possession of risk in the underlying economics. Now, question, can we say the project has a large gap between the seller and the buyer? Well, no, because it's about 6%. Now, 6% is because the value is about, you must record that this is $200 and something million, 208 million or so as the MMBOE, the minimum barrel of oil equivalent. So 6% gap between the seller and the buyer. It's not bad a deal, but it's good for for the buyer because he has an earlier time to break even at 10% return on his investment, and then the seller gets up to 16% break even, so which is higher. So the prospect of reaching a deal looks good in this context. Now, I have some points to conclude this session before we go into the other example section. Again, management must rely on precise USD value. Now, there's a concept on money models, as they call them. So there are different money models that run economies. There's the money of the day, you have the discounted money of the day, and you have the real money of the day. So it's good to understand the different type of money of the day models. You make sure that whatever you're looking at for a future return, you have to discount it to a factor so that you can be able to count your losses reasonably before you can venture into the project if they happen. And then qualitative factors alone can't assist managers to decide good farming alone. The balance of analysis is commendable. So you must understand the concept, and you must understand that there's a concept called the break-even point. If you recall, I've been mentioning break-even point in this discussion because it is really the point that makes projects economic or not economic. That is also very key. Now, negotiators are extremely important to map a value gap for the best deal. Now, they can't do that without an analysis that has been put forward by an advisor. That's the truth. So sellers has completed an underestimated value. Obviously, and this is a given, sellers will sort of always put their best foot forward, but buyers must do the work. A good example is if there is a pinch out in an asset, it's a geological term. Now, that has to be discovered or exploited, then you have to carry out a proper analysis of that case. Okay. Now, I'll look at a multi-case prospect, and this is the last session that we'll have. So licenses often includes multiple prospects, work programs, and of course, the EMV methodology is key. So the EMV is the expected monetary value, that risk, probabilities, and returns, and it gives a straightforward result. However, for multiple prospects, this gives some provisions of farming percentages that is attached to the expenditure work program. We'll see an example as we proceed. Here are two cases under the multiple case scenario. You've got the same project of 271 million NPV, project A, and project B is 250, close to that. Now, they have very distinct type returns. Chance of success of 25 and 15 here. Now, the break even for the prospect A, assuming you're looking at a chance of success of 25%, we have used 15 earlier. You see, it comes about $27 million as a farm out cost. And case 2 is about 12. So I've showed examples and how it's been calculated very simply, so we can be able to trace which is worth. Okay. Now, here I have about 3 questions or 2, I think, which I would like us to respond to as we progress. So question, well, what would have been the case if the chance of success is 100% and the well cost is unchanged? Clearly, I mean, it's already there in our previous example. It's about $271 million. It remains unchanged because now you must recall that the chance of success is a number that must not be more than 100%. There's no way you're going to have a cost that is 0 or there's no project, right? So your prospect of 100% chance of success means that you're certain that it will happen. So therefore, your NPV would be planned. Now, question 2, what would be the case if prospect B is 100% and the well cost drops to $10 million? I mean, you don't have to get the answers correctly, but it's a question that we need to just answer as we proceed. So clearly, the answer is about $240 million. The reason is simple. This provides insight into the farming's appetite to gauge cost. So lesser cost is higher return. So I'm going to show you how I got that answer clearly. And that's why I put the question first before the answer. Now, if you can see the analysis on the slide, you've seen that. So the first question is $270 million, right? So let's check. So clearly you can see that the chance of success here gives us a spread of the project economics with the well cost. That's the first chart on the left. You can see $27 million. That is because we have a 25% chance of success and well cost. All of the numbers you see on this section speaks to one point, that as you have a chance of success that reduces to the right, you see that there's a reduction in the return on the project. If you have an increased project cost as you proceed, you see that there's also an increased return. It's supposed to be reducing, but because you have a fixed, for example, on 100% chance of success, work cost of $40 million, you have 231 million. Okay. Now, a chance of success of B, which is on the right, looking at different results. I mean, I'm speaking to this example that is on the previous 2 slides. This one here, right? You see, we got 12% here as the farm out term interest, and here is 27.5%. So I've run the example scenarios on these two cases so you can see where the gray areas are. So now, the one on the right is for prospect B. So if you have a 25% chance and well cost, 15% chance of success, that's how you got that to 12.5 million. And the other is 27 million. So clearly from here, you can see that successful farm outs in multiple prospects are depending on chance of success and well cost. So before you make a decision on prospect to decide on farming in, you must ask the questions. What is the chance of success? And what is the cost that you need to be expensed or to be invested in? Very two key questions that must be asked. And so which is more favorable? So for question 3, what will the total cost of the multiple case prospect? It's a question. Now, well, simply just add them together because now you must remember that we're in a multiple case scenario where you have distinct two cases. It's more like adding two NPVs together. Very clear because you've carried out analysis of each of them separately. And so you can gauge the value. So the comments here are the higher returns in multiple plays, even with varying flexibilities in costs of success and investment provides higher returns because you're combining the two assets together on a return profile basis. If you are taking just one, it's 27 million. If you take the other one, it's 12 million. Now, if you combine together, you can go 40 million. So the seller here will be able to provide a basis to have an increased participation because he knows very well that you're coming in to partake in multiple projects. Okay. Now, my comment is you'll notice that the higher block value almost exactly compensates for the higher drilling costs. So what it means here is that if you have invested more in prospect 1, the return that you fail to receive to a certain degree balance out when you're in prospect 2 scenario, when you combine them together. Also, we must note that the outcome of the second is also assumed to be dependent on the first. Yes. So the 40 million that we saw depends on the 27 and the 12. So you can't have 240 without 27. So if you have those 12, it's 12. If you combine them, that's what it means. So just trying to round up, I've got some takeaways. I think it's important to have takeaways here because clearly I'm wrapping up the points together now, just within the 2 hours that I have. I've done about 1 hour, 30 minutes now. I've got 10 key takeaways here. It's good to start with clear objectives. You must define objective and the expectations of the farmings. And there should be alignment within the goals of what you intend to achieve. Now, you can't have clarity on the objective when you don't understand the economics of the project, obviously. And then you must carry out some proper due diligence. Have a comprehensive analysis, technical, commercial, and legal. And then you assess the risk and opportunities. I have provided a basis to do that by use of those various charts that's often done by Excel data tables. You must also provide a basis to understand the commercial terms. And what are what's the target? Is there a cost recovery? What regime is applicable? What's equity participation? Now, you must clarify the roles and responsibility of the party's job. Are you looking for a partner who wants to invest in just the exploration process, or you want a partner in development process? These are points that make your decision easier. Then you must also make sure that you have partnership management. You must be open to communications, build trust with potential partners. That's key. Share data as much as you can, and establish a clear governance structure if to the extent that there is issues of dispute resolution. You must provide a base to assess risk. There are a couple of models these days that assess risk on a standalone. But I also have a fair bias on Excel because it has, yeah, if you understand what is to be done, it's good to analyze it with what you can explain, right? So you assess the risk, mitigate them. You can't do all of this if you don't understand the context to which you're trying to farm into. And then you must now provide the basis for contingency planning for that event. And then you must drive expertise in your operational excellence, ensure that there's enough to feast on in terms of knowledge about what is to be invested in. and collaborate with operators and service providers. And then flexibility is key. Be prepared to adjust to changes and strategies, because if you don't try to adjust to these changes as a goal, there's a good chance that there's the interest to be weaned off as you proceed. And then you must be flexible to the market changes. So my response to this is ensure that you understand what the market value is for an asset. And the most important part of which you must do is to assess an analysis of the value of the oil prices in your model, impact of increased costs, possibly when it happens, and then understand the fiscal regimes, that drive that project. Compliance is also very key. Then you should be able to manage your stakeholders very well, engage with them, because they are really the promoter. I call them, they are like they're like you, you're like your enablers to ensure that the project works to achieve your intended goal. Forge good relationships, farmings, and be responsible socially. And then the final point is monitor and evaluate the performance of your farming. So you must make sure that as much as you have a 39% goal to achieve in a farming, it's not cast on stone. You must also show areas that are improvement prone and implement the changes to achieve those proposed outcomes as you proceed. And then I have my final concluding remarks. Ultimately, and it's in bold, a successful farm out should involve a fair understanding of your chance of success and your project value, for which the risk to the buyer and the seller needs to be analyzed in an exponential work program. Okay. So thank you very much, and I think I'm happy to take questions now. I think I'm in a good time. Okay. So thank you very much, and I will take questions now. Okay. Moderator, I'm standby. Questions?
There's a hand up. Akpan, are you there to moderate the question and answer session?
Okay.
Yes.
Okay, please go ahead.
So the question we have is from Rume, and Dr.
Okay.
Rume is asking, I want to ask if the farming fiscals have an impact in the actual unit cost of oil production.
Okay.
That has been answered previously.
Yes, I have answered that, and the answer is yes.
But there's a hand up from Dr. Agbola Olayinka.
Okay, Dr. Bola. Okay, I've seen the hand. Okay, Dr. Bola, please, can you ask a question, please?
Okay, good afternoon, everyone. Good afternoon, Engineer Desmond.
Good afternoon.
I hope you can hear me.
Yes, loud and clear.
Okay. Thank you so much for this wonderful presentation. And also, I want to specially appreciate the Spe Abuja branch, which I believe is the organizer of this program. I've really gained a lot from today's presentation. Yeah, I'm not an economist, but a facility engineer in E&P company. So because of the nature of my assignment that we always do FDP, Field Development Plan, most of the time when they run the economics, it's always been issued that maybe whether the FDP should proceed to the next stage for approval or not. So because of all these issues, I had to enroll myself on some economics studies online and as well as offline to really understand how economic model is being done. And I want to tell you that really I thought that I've known, but based on what you have presented today, I can see that I've not even known up to even 50%. Because the economic model that I'm familiar with is this tax and royalty regime, as well as the production sharing contract, modeling, investment portfolio management, and the like. All these like parts of spider diagram and tornado chart that you showed. All those I understand. But this concept of farm in and farm out, I only know the definition, but going deep to see how to run the economies and see whether to go into that, I didn't know up until now that you explained. Thank you so much. So I have maybe two questions for you and two questions for the organizers of this program. Question number one, sir, is that if maybe someone like me and other persons on this platform, if they want to also engage you, put them through, it will come at a cost, of course, but like, will you be available to go into practical sessions so that from beginning to the end, someone will understand, it's not just something that we can learn in a day, within 2 hours like this. So that's the first question. Then the second question is that when you were taking your presentation, you made mention of chances of success, and you have been relating it to well cost. So I want to know, why is it that you are relating it to the well cost? Why not a facility cost? I don't know why the basis why you are attributing it to the chances to the cost. So those are the two questions. I don't know, maybe you got my questions, sir.
Well, yes. Thank you very much. Thank you for the question.
Then,
Oh, yes.
okay,
Can you
then
hear me
for
well?
the other two,
Okay, go ahead.
I can hear you. Maybe I can go ahead. Then to the other two questions. Number one, to the organizers, that the slide be available for us so that we can go over it again. Then number two, I don't know, is there any physical place in Abuja here that people are having meeting of SPE? If there is, I would like to join to be a member. Thank you.
Okay, thank you. I will let them. I will let the membership of the SP respond to your last question, but I will take the first you asked. Yes. So the first point that you asked was if if I'm happy to have engagement for what so kind of like detailed training. And so, oh yes, why not? We have trainings on economics. We have advanced classes. We have physical classes, yes, to understand that, and also very keenly to understand the Excel modeling of projects, which is also very key to understanding models. Because models are run in Excel these days, right? Yes. So your second question, and it's very good that you asked the question, is you're asking if the chance of success um it was mentioned a few times and maybe very frequently. And you're asking if it was linked to why is it linked to facilities cost and well cost? Well, now maybe I'll go back to the reason why it was essential to mention it. The chance of success, as the name denotes, chance of success is what is the chance that we will be able to achieve these production volumes? What is the chance that these assets will return the value to which we plan that it will return? And being a student of mathematics, which I think most of us are, um, whenever you hear the word chance, it denotes probability, and it's always a number between 0 and 1. So a farmie and a farmer are trying to come together in a project. The only way they can be able to gauge a potential return that is not objective in their perspective, you want to be subjective, you should provide the base of chance of success. This is just a way of what we know it as what it is in the oil and gas space. If you were to vary it, that's one. Then number two, you do that because every time you hear chance of success, now it means that the certainty is one, which is certain that it must happen 100%. Now, it's good to also understand that if it is 50%, what is the chance? If these questions can be answered with clarity, and the only way I could do that carefully, the best practice is to show it using those data tables I shared. Now, just to put it a bit much more context, if I want to um, just go back on that slide, just to show you what that means in context is, assuming I go to the section where I'm trying to share what exactly is my chance of success in in option 1. So let me just go there quickly on the same slide here. Good. Now, on this slide, I've used the chance of success vis-a-vis well cost. Now, the 27 million you saw is a number that comes after an analysis has been done. It's a base number that we know that it is 27 million. Now, the question is that before we go to 27 million, there are different variables that were considered: MPV, well cost, chance of success, and working interest. All right. Now, for us to understand the impact of those variables without having to explain too much, Excel has a function that is called use of a data table. You can run scenarios on Excel. It comes in seconds, right? And then you can see different results. Now, you record that this is the base, 27 million. Now, and this is 100% here. Now, if you have different well costs and different chance of success, everything you see underneath are the various scenarios that has played out carefully. So, for example, if the well cost goes down from 40 million to 20 million, which is half it, now your number goes increased. Of course, a lower cost means higher return to 251 million. Now, it's key because it helps you to this is shown because these are what typically happens before you make a decision forward. You would have carried out a lot of analysis. So if you're in a negotiation room, right, whatever you're trying to propose as a case for consideration is backed by analysis you have done. You don't have to share the information anyway, but the point is you're speaking from the point of information and this is really what you think is a possibility. And that's why I began with understanding the project's return. What is the MPV first? From that point forward, you now start looking at different, okay, if oil prices are it's 5, what happens? If the cost is 3, what happens? So everything, typically 4 things drive projects: the capital costs, the operating costs, the production volumes, which could be risk probabilities again, and the oil prices. So if you can understand these 4 key variables and play around them in some analysis, you can tell exactly where you would typically want to land. Okay, it's very key for investment decision making. Thank you.
Thank you so much. I really appreciate it.
Thank you. I think someone has this up again. Okay. Dr. Malami.
Yes, thank you so much, Desmond. Wonderful presentation. Still on this matter, I'd like you to please explain more on how you determine the chance of success, because is it something that you just arbitrarily chosen that, okay, the chance of success for this project is, let's say, 10%, 15%? How do you come about this percentage? Please, could you shed more light on this? Thank you.
Okay. Thank you. We're having more questions on chance of success. Right. So very simply, your chance of success is really it's I'll say it's more subjective, if you allow. It's more subjective because the chance of success, it could be objective though also. Now, it could be determined by many factors. Now, one, you want to understand the likelihood that this could happen. That's one. Now, if that is clear enough, you can run the projects with various likelihoods. So how you can determine that is there's a good chance of success that, for example, um, most most assets have about maybe 30%, 25% chance of success in country X, assuming. Now, that's a known number. I have not called a particular country number or a type of asset number or a terrain number, or whatever it is. Now, the key thing is once you have this kind of understanding, what is key is you want to ensure that you have a broader perspective of how that number, and that is from a geological study or from previous work that has been done by the same company, has been done. Now, if you have those kind of understanding, the next part of it is now it gives you a basis to now project what to be your likely chance of success in your project. So one of the things you can do, one of the things that is very popular is, I'm sure you're familiar with the P10, P50, and P90 concepts. So the question will be, why do companies use a P50? The probability that 50% chance of what you get as a result volume. It's a question. The answer is because a P10 and P90 is different from the P50. The P50 is just like a stalemate. You're just staying just in the middle. There's a good chance that I want to I want to be a bit indifferent of being pessimistic or optimistic. All right. That way, all of these are distributions analysis that are often borrowed from the concept of, you know, exploratory work programs and exploratory efforts. Because really you want to make sure that you are gauging your results on some level of confidence limits that this could happen. I don't know if I answered your question well.
Yeah, thank you so much, Desmond. But what I'm actually asking about is whether or not there are some deterministic approach that you could use based on certain parameters to determine what, maybe by given some given parameters, what are the chance of success for this particular field or for this particular area. So that's what I mean. But if there is no any deterministic approach, then it's fine. We just maybe use historical data or and other means. Thank you.
Oh yes, actually, I think you mentioned the key word. Historic the data around the heuristics are very, very essential. And I think what is much more useful is how you use that information, because that gives you a clearer insight of what is a good chance for you or not.
Thank you so much. Greatly appreciate it. Thank you.
Okay, thank you. Any more questions?
Okay, let me ask my question from I think one key factor or determination in this farm-in process is the getting a deal break between the farmer and the farmer.
Yes.
So my question is now, is there a particular software for farming process whereby you can now put in your variables, your factors to achieve a deal break? Like put in various scenarios. Is there a software apart from maybe Excel, is a software only for farm-in process whereby you can simulate various scenarios?
Wow, that's $1 million question. I have not been aware yet either is a software that you can just plug in numbers and run scenarios. But I'm aware that there are a couple of softwares that do economics. I know a few, but I think I must also mention very clearly here that um, the result of any kind of means in terms of analysis really depends on the scenario at play, because there are various drivers that has to be considered before a deal is good for someone. What could be good for company A might not be good for company B, and the key result is you must understand the dynamics of where you're playing in, and address each context, in isolation. So I'm aware of any software at all, but I also have a first preference to sit down and put numbers in Excel based on understanding of what the case would be and from experiences. That way, that way, you don't want to put so much in a software or a tool that will cost you so much because something didn't just go right, or there was a bit of a lack of clarity in one area. So for me personally, I think it's best. I mean, although it's debatable anyway, it's best to understand the context and then run a model from first principles. Understand the NPVs, yes. Understand the different drivers of the project, yes. Then understand the farming ambition or the goal. So Deep Water said you need maybe X amount of millions of dollars. He wants to come in 30%. What working interest? Question that needs to be answered can easily be run on Excel. But I mean, I wish I have a software. I don't. But I don't think I'm not heard of any at all.
All right, thanks. Yeah, that's
Okay. Maybe I should work on a software soon myself.
yeah.
Okay. Any more questions? Questions, comments, okay, someone's hand is up again.
Yeah, sorry, it's not to ask any question, but to respond to one of the questions raised by the previous person. I think it is Engineer Lawrence. He asked the questions around how you can join SPE Abuja, and I think maybe the program the membership chair is not available on the call. But to just if you want to be a member of SPE, please reach out to the membership chair. And I think his contact has been put on the chat box. So kindly reach out to him. He'll put you through. So and maybe I will leave the program chair to answer on the whether we're gonna get the slides or and how we are going to get it. So I would love that to the program chair to respond to that. Thank you.
Thank you. Hello.
We can hear you.
hear you.
Okay, we can hear you.
Yes.
So thank you, Assistant Programs Chair. Normally, the moderator, Akpan, should, after a presentation, question and answer session, he should give participants details about membership, how to become a member of SP, and all the details you need to know. We are on Twitter, Instagram, Facebook. So this event is live streamed and all of that. So it is, go to any of the social media channels, you will see it. And of course, members on the platform, once you become an SP member of Abuja section, we have a platform, a group, a WhatsApp group where we share information, we share slides, we share presentation slides. So that would also go onto the group chat as well. So I don't know if that answers your question about how to become an SPE member. We normally hold monthly technical sessions as well. We hold physical, virtual, hybrid meetings at various venues. The last physical meeting was a distinguished lecture meeting we had at AUST. So there's no definite venue. We change venues depending on what the event is like. Sometimes we hold it at PTDF, AUST, or at the section's office, somewhere in Gudu, I think. Yes. So I don't know if that answers your question.
He also asked about the slides.
Yes, it will be shared on the platform. And then I can do a double confirmation from the moderator because he handles those yes, the slides. Am I being heard?
Loud and
yes,
clear.
ma'am.
We can hear you.
Loud and clear.
Maybe Engineer Lawrence is somewhere. I don't know.
Okay.
But I think the message has been passed. So thank you. We can just proceed. Thank you.
Okay. It seems Akpan is not on the call again. Let me quickly see what next on the agenda and then take it up. Okay, closing remarks. So I would ask my Assistant Programs Chair, Dr. Malami, please take the closing remarks.
Okay, so closing remark. Thank you so much, program chair who double as the section chair this afternoon. Thank you so much, Mr. Moderator. Engineer Desmond, we're really happy and we appreciate your presentations and your time despite all these many things that you have. Thank you so much for the wonderful presentation. For every member of the Abuja SPE section who took out his time to be with us this afternoon, thank you so much for your time and thank you so much for listening and being on this program to this end. And for any other person who is here to be a member of SPE Abuja, we are encouraging you to please take that bold step and be a member of SPE Abuja section, because we have a lot of programs. In fact, next we're going to have another program, which is going to be part of our monthly technical webinars. So please join us in that presentations too. So on behalf of SPE section 199, we thank everyone that is in this call, and hopefully you'll be with us in the next coming our program. Thank you so much.
Thank you so much, Assistant Programs Chair. Dr. Agbola, could you please drop your number on this chat now? I pick it up and I get in touch with you. And so that ends the meeting.
Thank you so much, ma'am, for.
Yeah, fine, is back.
Thank you so much, ma'am, for that, and thank you to our Assistant Programs Chair for taking the closing remarks.
Please confirm you can hear me.
Yes, we can hear you. We can hear you, Abba. Thank you.
Please confirm you can hear me.
Yes, we can hear you loud and clear.
Okay, so a few announcements as we wrap up the event. We would like to announce that we have an event on the 30th of January 2025, which is another monthly technical meeting. Of course, we have Dr. Pascal Ifaucho, who would be taking us on domestic liquefied natural gas in Nigeria, fuel to accelerate the development of the country. We also like to announce that you can register using the link which you have on your screen. And for those that were asking questions about joining Spe Abuja, of course, there are so many benefits of being Spe Abuja, or being a member of Spe Abuja, both professional members benefits and student members benefits. Of course, you can see it on the screen. To be a member of Spe Abuja section, it costs 86,500 naira. And for those that want to renew their membership, 69,500 naira. And of course, if you don't renew on time, you pay an restatement fee of 17,000 naira. The number of the membership chairman had dropped it on the chat box already. Again, you can see the number again. Kindly pick the number so that you can contact Dr. Ogolo on how to join Spe Abuja. Of course, the account details for those that want to renew membership, just do a screenshot. And of course, we'll be pleased to have you renew your membership. We are live on all social media platforms. Email us, spabuja@gmail.com for any inquiries. And of course, YouTube, Spe Abuja Session 199. All of our videos, including this particular recording, is on YouTube. Just search Spe Abuja and you would see the recording. Of course, we are on Facebook, X, formerly called Twitter, and of course, Instagram, Spe Abuja 199. I already announced about this event, and I hope that you can be part of the event. At this juncture, we say thank you for joining us. Thank you for joining us, and we kindly appeal for those still online. Possibly you can turn on your video cameras. Let's take a screenshot of the last 10 people we had on the call. So please turn on your video cameras, please. Thank you, Oga Desmond, for the amazing presentation. We enjoyed ourselves. Thank you so much for all you've shared. We celebrate you, sir.
Thank you very much. Thank you.
So ladies and gentlemen, please, we kindly appeal that you turn on the video cameras. So just do a quick photo and then we wrap up. the event today. Thank you. Okay. I think only 4 people want on their videos. Okay, so we'll just go ahead with that. So when I say SPE, respond with clean energy, and then you smile, your thumbs up. SPE.
SPE.
You respond with clean energy and you smile, your thumbs up. SPE.
SPE, clean energy.
Thank you. Ladies and gentlemen, we come to the end of today's meeting. See you next time. Bye for now.
Thank you very much.
Thank you.
Thank you.
Thank you.
Thank
you, Mr. Engineer Desmond. Thank you.
Thank you very much. Thank you so much.